Over the Road magazine article, October 2010. Saving meal receipts is a pain, so don't. The most hotly disputed topic in tax reduction today is meal and travel expenses. What can you write off and how much work is it to expense things? Keeping meal expenses was made popular after CRA's October 26 issuing of IC 73-21R9. It emphasized the need for both the employer and employee to sign the TL2 simplified method. Since most operators are self-employed, their employer is nowhere to be found. Prior to the bulletin, operators have historically always been able to use the simplified method. Now they are required to keep receipts. Tax preparers are split on how to handle this dilemma. Some require operators to keep receipts. Others ask for receipts as a backup, but still use the simplified method to calculate meal expenses in personal T1 filing. Still others don't even bother to ask for receipts, yet submit TL2 numbers. If you are unsure which system your preparer uses, just ask yourself if they requested your logbooks at the end of the year or the number of days you were gone. If the answer is yes, you are self-employed. They use the simplified method. If they used it, they usually have operators sign a waiver. Waivers are used to remove the firm's liability of CRA rejecting the meal expense, not enough receipts or none at all. If you signed a waiver and they used the simplified system, you are carrying liability whether you like it or even know it. So what are operators to do? Accumulate potential tax liabilities or a bag full of receipts? Crisscrossing the country, you will get a host of different perspectives, each usually passionately defended. The best alternative for operators is neither. They should change the reporting system used to file their business expenses. Instead of classifying themselves as self-employed, become an employee of their own company. Have an employer-employee agreement that stipulates a per diem reimbursement for job-related costs, meals. The system is easier than keeping receipts and fully utilized allows an annual tax savings of between $6,000 and $8,000 plus CPP savings. The system has very specific disadvantages, but in my opinion is dwarfed by the tax savings. There are setup costs, which can be minimized, and a definite learning curve, 2 to 6 months. But the most striking disadvantages are future financing issues and possible tax liabilities if not done correctly. The disadvantages are not insurmountable, but should be planned and prepared for, especially the liabilities. Make sure whoever is overseeing your per diem reporting is also liable to defend you, not voluntarily, just before court, but all the way if necessary. The disadvantages are not insurmountable, but should be planned and prepared for, especially the liabilities. Make sure whoever is overseeing your per diem reporting is also liable to defend you, not voluntarily till just before the court, but all the way if necessary. The system is not for the fly-by-nighters. It's for serious business operators who are willing to follow the tax rules to minimize their expenses. Have a good trip.